Hey everyone, welcome back to the Deep Dive. We're all drowning in economic headlines these days, right? Trying to figure out what's actually going on. So today we're going straight to the source, cutting through the noise. We're diving into the OECD's Interim Economic Outlook, fresh off the press from March 2025.
Yeah, you got it. It's their mid-year update, not the massive full-blown annual report. But still, it gives us a really focused look at how the global economic landscape has shifted since their last big assessment.
A kind of pulse check, right?
Uh,
And for us, it's about extracting the key insights, like what's the trajectory? Where are things headed? And maybe more importantly, what are the forces driving it all? So where do we even begin? The
yeah.
last time we talked global economy, it felt like, what, surprisingly resilient?
Yeah, 2024 exceeded a lot of expectations, right? Growth, especially in the US, even in some larger emerging markets like China, was pretty robust. Felt like we were navigating those choppy waters pretty well for a while there.
Resilient, okay. But
Okay.
what was fueling that? Why were we doing better than predicted? Well, a bunch of things, really. Income growth, strong in many areas. For a bit there, we also had lower interest rates, giving things a bit of a boost. That always helps. But I think things are feeling a bit different now, wouldn't you say?
100%. That solid ground, that we thought we were on seems to be, well, maybe not so solid anymore. Even the OECD report flags some potential trouble brewing.
Right, it definitely highlights some clouds on the horizon. Recent data, it's pointing to, well, some softening momentum. Business and consumer confidence, it's taking a dip in a bunch of key economies. And I think the big one, honestly, the most telling, is that jump, like a significant jump in global economic policy uncertainty. Everyone's just waiting, It's like, what's next?
Holding their breath a bit, yeah. And a big part of that uncertainty, got to be trade.
Right.
We're not just talking tariffs in theory anymore, they're happening.
Exactly. The report really zooms in on those U.S. tariff increases, those on goods coming from China, the steel and aluminum imports, and the ones in the pipeline, those planned increases for, well, Canada and Mexico.
Hmm.
And it's not just a one-way street. These things, they trigger retaliation, right? Other countries, they hit back with their own measures. It creates
They-
this, like, tangled web, this messy trade environment that, well, doesn't help anybody.
Yeah, definitely feels like a step back from global trade. And all this while we're still wrestling with, well, the I word, inflation. Maybe not front page news every day like it was a year ago, but
Oh, it's still there. Inflation is definitely still a thing. It's come down from its peak, for sure. We're seeing that. But, we're still dealing with some pretty stubborn pressure points. Services inflation, that's still high, often tied to those tight labor markets. Got to remember that.
Mhm.
And what's weird, or maybe not so weird, is goods inflation. It was like super low for a while, right? But now it's showing signs of life again. So yeah, that buzzkill you mentioned,
Yeah.
still buzzing.
Okay, so softening growth, inflation hanging around, that's the stage. So what's the big picture, according to the OECD? What's the next couple of years looking like? Let's start with growth, global growth projections. What are they saying?
Well, generally a gradual slowdown. That's the expectation. So they're predicting 3.1% growth for 2025, and then a tiny dip to 3.0% in 2026. Now, here's the thing, the really important thing to remember. These numbers, they've actually been revised down from what they were predicting back in December 2024.
Yeah.
So, yeah, definitely more cautious now.
So that early optimism, yeah, fading a bit. Why, though? Why this slowdown? What's putting the brakes on things?
Well, they really pinpoint those trade barriers going up, especially within those big G20 economies. That's a major drag. And then add to that the whole geopolitical uncertainty, the policy uncertainty we talked about. It all creates this climate where, well, businesses hesitate, they're less willing to invest, and folks, they get cautious, they hold back on spending. It's just natural. When the future feels shaky, everyone kind of tightens their grip on their wallets.
Makes sense. Uncertainty, roadblocks. Not exactly a recipe for economic confidence. Okay, so global picture, got it. But how's this all playing out in different places? What about the U.S., the big guy?
Yeah, the U.S., they were surprisingly strong in 2024, but the OECD is seeing a slowdown. So they're saying 2.2% growth in 2025, and then slowing down even further, 1.6% in 2026.
Yeah.
So yeah, cooling off after a pretty hot year.
Significant drop.
Yep.
Okay, what about the Euro area? They've had their own challenges, right?
Yeah, Euro area, things are looking, well, subdued. OECD projection is pretty weak growth, just 1.0% in 2025, and then edging up a bit, 1.2% in 2026. They really single out that uncertainty factor, saying it's the main thing holding them back. And, there were actually contractions in France and Germany towards the end of 2024. Not exactly picture of booming growth, is it?
Definitely not. Sounds like they're still in those choppy waters. And what about China? The supposed engine of global growth? What's
Yeah.
happening there?
Well, China's slowing down too. They're projecting 4.8% growth in 2025, but then down to 4.4% in 2026. It's still growth, right? But compared to what they used to see, it's definitely a slowdown.
Okay, so slowdown pretty much across the board. Now, for a lot of our listeners, I'm thinking Canada and Mexico, the situation there is going to be particularly interesting given those planned U.S. tariff increases. What's the outlook?
Yeah, this is where those trade policies really start to bite. The impact is very real. So for Canada, significant slowdown from 1.5% growth in 2024 down to just 0.7% in both 2025 and 2026. The OECD is very clear they're directly attributing this to those U.S. tariffs, especially because the U.S. and Canadian economies, they're so intertwined, right? I think automotive, agriculture. So yeah, for you guys in Canada, it means potential headwinds, especially in industries relying on that cross-border trade.
Ouch. That's a big drop. And what about Mexico?
Mexico. Oof. They're actually facing a projected recession. Output decline, 1.3% in 2025, then another 0.6% in 2026. Again, the OECD is laying a lot of the blame on those U.S. tariffs. They disrupt those supply chains. And Mexican goods, they become more expensive for U.S. consumers, so demand drops. It's a tough situation.
Wow, that's a really tough situation. Really underscores how connected all these economies are, how quickly, a decision in one place can ripple out and hit its neighbors. Okay, so let's shift gears a bit. Talk about inflation. We know it's been a global headache. What are the OECD's projections on that?
Well, they're actually projecting higher inflation than they previously thought, although it's still expected to, gradually come down. So for the G20 as a whole, headline inflation is expected to go from 3.8% in 2025 down to 3.2% in 2026.
Okay, so a little bit of relief, but...
But here's the thing to remember, right? Core inflation, which basically filters out those jumpy food and energy prices so we can see the underlying trends, that's projected to stay above central bank targets in a lot of countries, including the U.S., even in 2026. So it's like those underlying inflationary pressures, they might be stickier than we'd hoped.
So even if those headline numbers ease up those deeper pressures, those are still a real challenge. For policymakers, for sure, but also for our wallets, right? Now, the OECD report, it also looks at a scenario where those tariff increases, maybe they're less severe or they don't happen at all. What would that look like?
Right. They modeled that, a scenario with lighter tariffs, just between the U.S., Canada, and Mexico. And in this case, you see a pretty noticeable improvement, both in economic performance and in lower inflation for all three. For example, for Canada, their growth in both 2025 and 2026, it could be a whole 0.6 percentage points higher, reaching 1.3% in both years. Mexico, they could see growth of 0.1% in 2025, then 0.8% in 2026. That's a huge turnaround from that recession we were just talking about.
Yeah.
And even the U.S., they'd see a small uptick in 2026, reaching 1.7%. So yeah, it really shows how much these tariffs could potentially cost them.
It's like a before and after, It really drives home the point that trade policy, it's not just some abstract thing. It has a real impact. Jobs, growth, the prices we pay.
Okay, so beyond the projections, the OECD also lays out some potential risks, some challenges that could, really shake things up. What are they most worried about? Well, there are a few things. The big one is like further fragmentation of the global economy. If those trade barriers, if they keep going up higher or broader than what they've already included in their projections, that would be a huge blow to global growth. And it would probably add fuel to the inflation fire. So a nasty downward spiral.
Yeah, like shooting ourselves in the foot, economically speaking. What else are they worried about?
Well, inflation, if it turns out to be stickier than they think, that's a big concern. If those underlying pressures we talked about, if they don't ease up as much as they're projecting, then central banks, they might have to keep those interest rates higher for longer. And that could spook the financial markets.
And you know what? There's already been a bit of a rise in those household inflation expectations in some economies, which is never a good sign.
Right. Makes people nervous. Now, the markets, they've been, relatively calm despite all this uncertainty swirling around. Could that be a risk in itself? Oh, yeah, absolutely. The report talks about something called stretched asset valuations and low risk premiums. Risk premium is basically the extra return that investors want for holding riskier assets.
Yeah.
If those premiums are low, it might mean they're kind of, underestimating the possibility of something bad happening. So any unexpected shock, any bad news, it could trigger this like rapid repricing where asset values just plummet, could lead to, financial instability.
That's a bit fragile, the whole system. Any good news? Anything the OECD is looking at that could actually, make things better?
Yeah, it's not all doom and gloom. They do point out some potential upsides. Like, if those trade restrictions we've been talking about, if those were reversed, that would be huge, right?
Yeah.
boost global growth, help lower inflation, a peaceful resolution to any of those geopolitical conflicts we've got going on that would reduce uncertainty and give everyone a bit more confidence. And then there's energy prices. If those were to drop even further, maybe due to increased supply, that would definitely provide some relief from inflation. They also mentioned increased government spending in some areas, like defense. That's not fully baked into their main projections, but it could give the economy a short-term lift.
Okay, so there are a few wildcards that could make things better. Now, I know the OECD also modeled the scenario where, well, things go the other way. Trade fragmentation gets worse. What does that look like?
Yeah, this is where they model a world where the U.S. increases those tariffs on non-commodity imports, like a 10 percentage point increase across the board. And then everyone else retaliates, hits back with similar increases on U.S. imports, and the impact, pretty significant. They're saying global output could fall by about 0.3% over 3 years. Global inflation, it would increase on average by about zero point 0.4 percentage points each year over those 3 years. And world trade, the volume of trade, could drop by nearly 2%. It really shows how interconnected everything is.
Yeah, those are some sobering numbers. So how would that shake out for different countries? Who would get hit hardest?
Well, the U.S., maybe surprisingly, they take a pretty big hit themselves. Output would decline, like 0.7%, and inflation would go up 0.7 percentage points on average each year. Canada and Mexico, because of their strong trade ties with the U.S., they'd also get hammered. And it wouldn't be even across the board. Some sectors would be hit much harder, like motor vehicles, parts, machinery, equipment.
It's a good reminder that protectionism, it often backfires. Okay, last thing. What are the OECD's recommendations? What should policymakers be doing about all this?
Right, well, on monetary policy, they're basically saying central banks need to be super careful, super vigilant. Because of all the uncertainty and because those higher trade costs, they could really feed into those wage and price pressures, make inflation worse. But they also say that if inflation expectations stay stable and if those trade tensions don't get any worse, then central banks in economies where, underlying inflation is expected to cool down, they should continue to lower those interest rates. So it's a real balancing act, trying to keep inflation in check while also supporting growth. Not easy.
Yeah, sounds like a really tricky situation for central bankers. What about on the fiscal side? Government spending and taxes, that kind of thing?
Well, they're really emphasizing fiscal discipline, keeping that government debt under control. That's super important, especially since debt levels are already high in a lot of countries. Being fiscally responsible, it gives you the flexibility to respond to any future shocks and to deal with those long-term spending pressures. Things like, aging populations, climate change. They also pointed out that just the cost of servicing the existing debt, that's becoming a bigger burden.
Makes sense. Don't want to overspend when things are so uncertain. And what about international cooperation? What role does that play in all this?
They see international cooperation as absolutely crucial. Countries have got to work together, to address those growing concerns with the global trading system. They need to prevent any further escalation of those trade barriers. They even ran a scenario showing that if they just reduced some of those existing tariffs and non-tariff barriers, even a small reduction could actually boost global output and help bring down inflation. It's a pretty strong argument for cooperation instead of, everyone just going it alone.
Yeah, definitely a case for less conflict, more working together. Okay, last thing. What about policies within individual countries? What can they do to strengthen their own economies?
Yeah, those structural policy reforms, they're really important for the long term. The OECD, they highlight the need for reforms that promote competition, like cutting down unnecessary regulations. They also want to see policies that help trade and resources flow more easily within countries. They specifically mentioned Canada's interprovincial trade barriers and the occupational licensing in the U.S. as examples. And then they're really big on promoting technology, new technologies, AI specifically, investing in that digital infrastructure, keeping markets open, and focusing on skills development so that people can adapt to those changes. They even estimate that AI could significantly boost productivity in the U.S., maybe zero point 0.4 to zero point 0.9 percentage points every year over the next decade.
Wow, that's huge. So basically fostering innovation and efficiency, and then investing in people, making sure their skills are up to date.
Exactly. Policies that support those things, that's what they're calling for. Making sure those skilled workers are in the right jobs. That's crucial for staying competitive internationally and for dealing with those negative impacts of trade barriers.
No.
OECD research, it shows that just closing that adult skill gap and making sure people are in jobs that match their skills, that could lead to huge productivity gains, like 17% from closing that skill gap, another 5% from better job matching.
Okay, so to wrap it all up for you, our listeners, this deep dive into the OECD's latest outlook, it's basically painting a picture of moderating growth, some stubborn inflation, and, well, a whole lot of uncertainty, mostly driven by those trade policy shifts and those ongoing geopolitical tensions.
And it's really important to remember that those projections, they're based on assumptions about trade policy.
Mm.
And as we saw, even a small change in those tariffs, it can have a huge impact, especially on those tightly connected economies like the US, Canada, and Mexico.
Right, so it's interconnected. That's the takeaway. What happens in one place, it affects everyone. So here's a thought, something to think about. Given all this complexity and uncertainty, what can you do, whether you're an individual or a business, to navigate all this? How do you build resilience, knowing that these big global decisions are happening, but they have a real impact on your daily life? It's a tough landscape out there, but hopefully, this deep dive gives you a better understanding of what's going on. Thanks for listening.